Ask a simple question. Why does money feel harder to understand the more advanced the world becomes? Why do the people who run the financial system rarely explain it clearly, and when they do, the explanations feel intentionally dense, technical, and unreachable? Here's the mystery. If the financial system exists to serve society, why does almost no one fully understand how it actually works? Why do markets collapse while experts say everything is fundamentally sound? Why do crises arrive unexpectedly, yet somehow benefit the same players every time? Why does responsibility vanish inside layers of jargon, models, and committees? Because financial complexity wasn't an accident. It didn't evolve naturally just to manage growth. It was built layered by layer to do something far more powerful, to hide truth, diffuse blame, and protect control. Stay with me, because once you see how complexity works, you can never unsee it, and the system stops looking neutral. Setting the stage when money was simple enough to blame, there was a time when finance was simple enough to understand, and dangerous because of it. If a king raised taxes too high, people revolted. If a bank failed, depositors knew who was responsible. If a currency was debased, prices rose and blame was obvious. Power had a face. Money had limits. Decisions had consequences. Most importantly, failure was visible. That visibility made authority fragile, and fragile authority looks for insulation. Origins, the first layer of complexity. The first layer of financial complexity wasn't created to deceive. It was created to solve a real problem: scale. As economies expanded, simple systems broke down. Gold was heavy. Trade was slow. Accounting was crude. Banks introduced paper claims, double-entry bookkeeping, credit instruments. These innovations made commerce faster and more efficient. But they also did something subtle. They introduced abstraction. Money no longer needed to be seen to exist. Value no longer needed to be immediate. Trust replaced verification. This was the first trade-off: efficiency in exchange for transparency. At the time, no one noticed the cost. The first twist: complexity as shield. As banking grew more influential, something unexpected happened. Complexity stopped being just a tool. It became protection. When systems are simple, responsibility is clear. When systems are complex, responsibility dissolves. If a merchant fails, he failed. If a bank fails, it's systemic. If a system fails, it's nobody's fault. This is where complexity began to change purpose. It didn't just manage money, it managed accountability. The rise when finance outgrew democracy. By the late 19th and early 20th centuries, financial systems had grown beyond public understanding. Central banks emerged, bond markets expanded, international lending became normalized. These systems required experts. Experts used models, forecasts, technical language, closed-door deliberations. Public oversight faded, not because of secrecy, but because of inaccessibility. People didn't agree or disagree. They deferred. Complexity created authority. In effect, WHY complex systems create dependence. Here's the cause and effect chain at the heart of financial complexity. Step 1. A system becomes too complex for the average person to understand. Step 2. Decision-making shifts to specialists. Step 3. Specialists write the rules that govern their own behavior. Step 4. Mistakes are framed as unavoidable, not accountable. Step 5. Power concentrates. This isn't conspiracy, it's structure. It's a breaking point when complexity became necessary. The true explosion of financial complexity occurred in the 20th century. 2 world wars, the Great Depression, globalized trade. Governments needed tools too. Stabilize economies, finance massive spending, prevent panic, so they created centralized monetary policy derivatives markets. Sophisticated debt instruments, each tool solved a short-term problem. Each tool added another layer. Complexity stacked upon complexity until no single person understood the whole system. That's when truth became optional. 1971, the moment transparency ended. When money was severed from gold, complexity became mandatory. Without a physical anchor, value had to be modeled, stability had to be managed, trust had to be engineered. Central banks gained unprecedented power. But with that power came a problem. How do you explain unlimited money creation to the public without causing panic? You don't? You bury it under technical language, policy frameworks, academic debates. Lagging statistics complexity became camouflage. The fallout: how complexity hides consequences. After money became abstract, strange things happened. Debt exploded but was called stimulus. Asset bubbles formed but were called growth. Inequality widened but was called market efficiency. Complexity reframed outcomes. Instead of asking, who caused this, the public was taught to ask what went wrong with the model. Blame moved from people to systems, from decisions to equations. The Cantillon effect, lost in the noise, one of the most important truths in economics, is rarely discussed publicly. New money enters the system unevenly. Those closest to creation benefit first. This effect explains asset inflation, wage stagnation, wealth concentration, but it's buried under complexity. Why? Because acknowledging it would expose policy bias, structural inequality, intentional design choices. Complexity doesn't just obscure mechanics, it obscures distribution. Financial engineering, when complexity became profitable as markets evolved. Complexity became a product. Derivatives, structured products, securitization, synthetic instruments. These weren't created for the public. They were created to increase leverage, shift risk, exploit regulatory gaps. The more complex the product, the harder it was to regulate, and the easier it was to profit. Understanding became optional. Participation was not. The 2008 crisis, a perfect case study. When the global financial system collapsed in 2008, complexity did exactly what it was designed to do. Responsibility was diffuse. Blame was abstract. Mortgage-backed securities, collateralized debt obligations, credit default swaps. Even experts struggled to explain what failed. That confusion wasn't incidental. It was the system protecting itself. And then came the bailouts. The aftermath: complexity as justification. After the crisis, the public demanded answers. What they got was longer regulations, thicker rule books, more acronyms, more committees. Complexity increased. Why? Because complexity doesn't threaten power. Simplicity does. Failed fixes: why transparency never arrives. Every crisis produces reform. But reforms never simplify the system. They add layers. Why? Because simplifying finance would expose incentives, clarify responsibility, limit power. Complexity is safer. It allows officials to say, it's too complicated to explain, and the conversation ends. Modern parallels: complexity everywhere. Look at finance today. Algorithms trade faster than humans can react. Models decide creditworthiness. Policy is guided by forecasts no one can audit. Money moves globally in milliseconds. Responsibility moves nowhere. Even inflation is debated through statistical adjustments, exclusions, revisions. Reality is filtered. The shocking pattern: every major financial failure shares the same features. Excess leverage, complex instruments, diffuse accountability, public confusion, elite rescue, increased complexity. Not once, every time. Complexity doesn't prevent collapse. It survives collapse. Why complexity works so well? Because it exploits human psychology. People fear what they don't understand. They defer to authority. They assume someone else is responsible. Complexity turns citizens into spectators, and spectators don't rebel. The deeper truth: financial complexity doesn't exist to explain reality. It exists to manage perception. It keeps systems running without consent. It keeps power intact without visibility. It keeps responsibility diluted beyond reach. Truth isn't hidden behind locked doors. It's buried under explanations no one can finish reading. The repeating cycle every generation is told: this system is too complex to change. Trust the experts. There is no alternative. And every generation watches the same outcomes repeat. Complexity isn't broken. It's doing exactly what it was designed to do. 3 clear takeaways. 1. Complexity is not neutral. It protects power by obscuring cause and effect. 2. The harder a system is to explain, the less accountable it is. Opacity and control grow together. 3. Financial truth is simple. Its presentation is not. When explanations grow longer, incentives are usually being hidden. Final warning and open question: History shows that no system collapses because people understand it too well. They collapse when understanding disappears completely. The question isn't whether financial complexity hides the truth. The question is how long a society can remain free when its most important system is intentionally incomprehensible. Call to action. If this video made you question what you've been told about finance, share it. Subscribe for deep, serious explorations of money, power, and hidden systems. And comment below, what financial concept were you told was too complex to question? Because the moment you demand clarity, complexity loses its power.